So in this video, I'm going to teach you everything you need to know about PE ratio. So I'm going to go through how to calculate PE ratio, which is very straightforward. What does it mean when it calculates the PE ratio? And how do you look at the industry PE ratio to get a sense of what's happening in the market? And I'll also explain whether a high PE ratio is good or whether a low PE ratio is good. So let's get started. So 96.4% of you guys are not subscribed yet. It is free and you can always change your mind in the future. And in terms of Investing Accelerator, this month I'm looking to help 20 professionals without a financial background to master investing. So the stretch goal is 30 and there's more details at the end of the video. So price to earnings ratio is fairly straightforward. It's price divided by earnings, which is how much the company makes at the end of the year. You can use this ratio to compare with other companies to see if you're overpaying or underpaying when you're buying the company's stocks, or you're buying a real estate, or you're buying a private company as well. Now, what's interesting is that price to earnings ratio is very popular and management knows this as well. So price to earnings ratio is also getting manipulated a lot when it comes to running businesses. Why don't we just dive in and take a look at the industry standard when it comes to price to earnings ratio. What I want to use is really FINVIZ because it provides a lot of useful visualization. So I would go to, for example, maps here, and then I would use a bubble chart. And then what I want to see is really price to earnings ratio, which is PE here on the x-axis. And then on a y-axis, I want to find the stock growth. So I can choose somewhere between 1 week, 1 month, 3 months, 6 months to 1 year performance. So I'm going to choose 1 year performance. If I invest in the beginning of the year, I want to know what happens by the end of the year. So 12 months is what I'm looking at. Now, right off the bat, what you'll find is quite interesting is that it is scattered all over the place. You have a couple of outliers. And for example, Tesla is way out here where you see the price to earning ratio is 1,500 times. And what that means is the price is 1,500 times higher than the stock price increase. And the stock price increase for the last 12 months is 400%. So you can see that there is the growth you're looking for. Tesla, Etsy, and EMPH are one of the few stocks that in the last 12 months have gone up above 300%. Now, is it always true that if you have a higher price to earnings ratio, it means that the stock price will go up? Well, not necessarily, because if you look at this company, GPC, who knows what that is, the price to earnings ratio is 4,000, but the stock price increase for the last year is around 0%. So you can see that what you're seeing here are outliers. And what you want is really to eliminate the outliers, so then you understand the relationship between price to earnings and the stock improvement. What you will find is that the stock price increase or decrease for a certain year does not have a very strong relationship with price to earnings ratio. Now, if it does have a very strong relationship, then you'll see the band being very narrow. But right now you can see that the volatility or the fluctuation or the range is all over the place. So that's why if you're just using price to earnings ratio alone as an indicator, is probably not good enough to make you a profitable investor. Because here's what some of the hypotheses can be. You can be like, okay, I want to look for a low price to earnings ratio, which is around here, below 20, and then I'll buy these stocks. But when you buy them, it doesn't necessarily mean they'll go up, because you get this whole section of stocks that are going down with a low price to earnings ratio. Now, alternatively, you can say to yourself, I can buy high price to earnings ratio stocks like above 40, maybe even above 60. And here, and you do see some stocks that are going down as well. So using this criteria alone is probably insufficient. And you can see this data clearly communicating that to you. And when you take into account how management can manipulate price to earnings ratios, different company with different level of debt is going to have a different price to earnings ratio. It just becomes a very noisy indicator, and it's not a one size fit all. What I'm going to do now is to dive into a couple of sectors which I think are interesting to you to give you a better feel. So the first one is technology. So here we're at technology now, and you can see majority of them is clustered around here, except a couple that are all the way out here. So we're just going to eliminate all the outliers. So after we eliminated the outliers, you can see that, hey, it seems like the average, it's around 30 to 50. Now, the next sector I want to choose is really financial, because that is a more stable industry. So then I think the PE ratios are going to be lower. So this will give you a contrast when you compare that to the technology industry. So right off the bat, before we even filter for anything, you can see that PayPal is one of the leading ones. This is more like a technology company. I don't know why they group it in here, but I guess they are doing payment solutions, so that's why it's out here. And then you can see the PE ratio is 100. So this is already less than the technology sector. And if I filter that out just to get to, let's say, around MSCI here, then you can see that majority of the price to earning ratios is actually somewhere between 10 to around 25. Now we can stretch it and say it is 30, but I would say around 15 to 20 is really the average at the moment, which is a JP Morgan, Bank of America are the two biggest bubble here, and then you get Visa and MasterCard, which are closer to payment solution, which are more technology focused, which is why they have a higher price to earnings ratio. Now when you think about this, then you can actually compare it to the technology industry to realize that the industry for the financial services PE ratio is lower. So when you're comparing the PE ratio, you need to compare it within industry. And you probably want to do an additional filter like market cap or something, and you want to compare, let's say, large. And that will eliminate a lot of other companies that are smaller. They might have a ridiculous PE ratio, so then you get a more apple-to-apple comparison. That this is not the end-all, be-all indicator, because price-to-earning ratios can always be manipulated. And one way to manipulate price-to-earnings ratio is to have more debt. If you have more debt, then you have a higher interest, you have a higher return on equity, but you have a higher price to earnings ratio because your earnings is lower. So even if you're looking at the financial industry right now, and I filter for large cap, you can see that there is no clear relationship between a high or a low price to earning ratios versus last year's performance. And you can see it's scattered all over the place. The next time you're going to use price to earnings ratio, you need to be careful, because just because something is low doesn't mean it's good, and something is high doesn't mean it's bad as well. So that's it for this video. So if you're new to the channel and you want to learn more about investing, then I have prepared a free 4-hour training on my website. And this is perfect for you if you're a full-time professional without a financial background or a retiree without a financial background and you want to manage your own portfolio with confidence. The goal is to get 30% return, and you can grab this free training in the description below, 5minuteinvesting.com/free case study. And within Investing Accelerator, I just want to celebrate another batch of successful case studies where Mary made 48.88% from Alteryx in 2 months, Aaron made 58.9% from Alteryx in 28 days, and finally Tony made 30% from Alteryx in 1 month. So congratulations to Mary, Aaron, and Tony. You did a fantastic job when it comes to investing. So I look forward to the next one. And for Investing Accelerator, this month I'm looking to help 20 professionals without a financial background to master investing. The target is to make 30% return, and the stretch goal is 30 people. So if you want to join and apply for the program, then you can go to the description and watch the free training to start. And in terms of the book giveaway, I'll be giving away another copy of Sam Walton, Made in America. So if we reach 100 likes for this video and you leave a comment below, then once we reach 100 likes, then I'll select a winner. So I'll see you in the next video.